All right, I'm back. It's about 8 a.m. I think, 8:30 on Tuesday, and I decided to have another semi-rant. It's not a full financial rant, and it's around inflation. One, because it seems to mystify people, and two, because it's affecting me. It's affecting us. So I thought I'd get this off my chest. What is inflation? I guess one, it's painful. Two, it's misunderstood. Three, it's avoided. Four, people pretend it doesn't exist. Five, they don't know how it impacts them. And six, I would say it's something people say on the news that they say, oh, inflation is up until now 2%. And people go, oh, I say, all right, I got a 2% pay rise. But that's actually nonsense in my opinion. Inflation is way easier to work out. Let's take this year, for example. I'm taking something in the UK which is actually quite accurate. So there are places where the rent has gone from 1,000 to 1,200 a month this year, 2022, and actually in fact it was 2021 into 2022 due to the pandemic. Fuel has gone from £1.50, even less than that, £1.40 up to £1.80. Utilities, so gas and electric, might have gone up from £100 a month to £120 a month. All of those are 20%, around 20% increases. Cars have gone out of control. In some cases, they're 30-40% more. I've had friends who have bought brand new cars in 2018 and 2019 that have been offered more than they paid because they got them at a discount for the dealership to buy them back into stock, which means they're selling them even more than that. Now, that never happens. The first couple of years, 2 to 3 years, you're usually losing 30 to 40% of the car's value, especially once it comes out of warranty, but not at the moment. So what does that mean? Well, to me, that means real inflation is 20% plus. They'll convince you in the UK at the moment it's around 6%. I think here in the US it's around 7%. But what numbers are they using? I do know what numbers they're using, but really what numbers they're using. Inflation is actually really personal. And you can work out what your inflation is by looking at your council tax bill, your utility bill, your rent increase, looking at a place. Let's say you need to move somewhere. Well, how much has it gone up in the past year? Or since you last rented a place, how much is a house increase? Here, the houses are up 30-40% over the last year to 18 months. Well, that's real inflation. And why is that real inflation? Well, it's what you have to spend out. So if your baseline is, let's say in the UK, an average salary of 30,000, you're living to that 30,000, let's pretending you spend every single penny, forgetting tax, every single penny of that. But now your life costs 36,000, which means you've had a 20% real increase, which is 20% inflation. So if you're using the price of oranges and whatever else they use, coffee beans, to measure inflation, but you don't buy those things, it's kind of irrelevant. You can just look at what it costs in addition for you to live your life, and that is inflation. There's another fun part to this where you'll get that, especially if you're employed, or only if you're employed, you get this amazing email or notification that says, after much discussion, the board have decided we're going to give you a 1.8% increase this year. And you'll always get that when you're employed for a corporation, so you have a yearly increase. And it's often, actually that's not true. In the UK, they did a freeze on people that work for the government, so teachers, nurses. I can't even remember how long, it's for an obscene amount of time where they held their salaries. And so few people have an understanding of what that means. So let's just take that 20% increase. Let's take a usual increase, which would be somewhere between 2 and 5% on your life. So in 2017, 18, 19-ish, let's say it's between there. Well, if you've had a salary freeze, year one, your salary stays the same and everything that you purchase goes up 2%. Okay, not the biggest impact. Year two, it goes up 2%. But remember, that 2% is on top of the 2% they raised it this year. But your salary is the same as 2 years ago. The third year goes up 2%. So 2% on 2% on 2%. This is how you end up losing a lot of your buying power. And unless you increase your salary or leave the job and get a new job with a better salary somewhere else, you're constantly losing. And then when they say, oh, great news, we've decided to increase your salary by 2% this year. Well, you're still on a salary of 5 years ago. You're now at a deficit of 10% to everybody else. So it's very, very difficult to catch up, or impossible to catch up. Mathematically, you can't catch that. If your salary after 5 years of being held goes up at the same rate as inflation, you can never catch it because it's on a curve like this, which is another point actually, which is compound. It's exactly the same as compound interest. So if you understand that, if you don't, go and have a look at some compound interest calculators. But if you save £100 and you get 10% a year and you've got 110, and then the following year you get 10% on 110, it's exactly the same for inflation but working against you. So if you don't have an understanding of compound interest, please go and look that up and then apply the same logic to inflation. Unfortunately for us, the year of 2020, 2021 and 2022 have been out of control. So the inflation is far beyond what anybody can keep up with in terms of your salary growth. So the important point here is, how do you manage inflation? Well, you buy assets, because inflation inflates the asset price. Housing is the perfect example. And I'll give you a personal example of why it's frustrating for me at the moment. Let's just use housing, forget stocks and everything else. Let's say your house is worth £100,000 and inflation is 10% and your house goes up to 110,000. Okay, your asset value is increased exactly the same amount as inflation. Let's say only affected homes. Great. So you don't have more income, but you have the same value, so personal wealth, as you did the year before, because you've gone up 10% in line with the inflation of home prices. So in this case, all you needed to do was own a home. That's it. Even if you have an interest-only mortgage, the same applies, because your house is worth 110,000. You have that same amount of value built in or baked into that asset. Where it will catch you out is the position that we're currently in, which is we have spent the last probably 5 or 6 months looking around to find out what's the best investment opportunity for us, and it's going to always be around homes. So we've been to Florida, we've been to places in Vegas, northwest Las Vegas, and we've been looking. Now, the home prices are increasing at a rate that is barely sustainable, in my opinion. Which is fine, because up until now, and to give you a real example, when we put the deposit down on our home, or when we were originally looking at our homes being built currently, the interest rates are around 2.7%. Today, the interest rates are 4.95%. Now that's only, it's a ton of money. It's about a $500 per month increase on our mortgage. So nothing has changed, but because we can't take the mortgage out until we buy the home, let's assume it stays the same. That's 500 more than we assumed it would be way back in whenever it was August. Okay, that's manageable for us. However, when you're looking at a home now, a new build home now, the prices on our home alone have gone up, I think, 80,000. So the value of the home has gone up 80,000 from when we agreed to purchase it, and the interest rates have gone up 2.2%. So that presents a whole set of risks when you're looking at it as an investment opportunity. So house prices are the highest they've ever been, and interest rates for us since coming to the US are the highest they've ever been. Normally what you would expect is home prices high, interest rates low. Interest rates high, home prices stable or low. We're in a position now where home prices very high, interest rates to us coming from the UK also very high. What does that mean? Well, that means if there is a crash, you're going to get burned 2 ways. Firstly, you've got a home which is now not worth the value that you paid for it. Secondly, you have a mortgage which is higher than you can really afford should somebody not be able to afford to pay. So if there's a financial crash, let's assume that person that's living in the home loses their job. Well, now you've got a $3,000 per month plus taxes mortgage that you need to pay. And even if you can get them out of the home, I don't know how it works here in the UK, it's very difficult, you now can't sell that home because you're going to take a massive hit on it. If the markets crash, home values go down, and your mortgage stays the same, which means you're kind of stuck in this really difficult position. So for me, I've spoken to Celine and said, I think we need to pause on looking at homes, because we don't have a big enough financial cushion to absorb, let's say it crashes in 3 months or 6 months from when we buy it. I don't think we have a big enough financial cushion to absorb the potential downturn and somebody losing their job and us having to pay. Sure, we could pay out, but it's going to impact our life significantly. So even though I'm talking about how to manage inflation, it's a long-term gain. So for us, fortunately, we have properties in the UK and they've gained at the same rate as inflation, maybe a little bit more because we bought at good times. We bought right at the beginning of the crash, and our other properties bought 6 years ago. So it's gained enough equity that even if the market was to crash, same applies to stocks and shares. People look very, very short term, but in actual fact, because most of our stocks and shares were bought years ago, even in this current downturn, nearly everything we have is up. There are 2 stocks that are down, and I think one's down 6,000, the other's down 3,000. But our overall, we're still up about, as a percentage, 40%, just because time compounding, effectively, time pays that back. But if you're on a short time frame and you're really close on budget, for example, us buying a home now, you could get burned very, very quickly. So it's kind of, you have to be sensible. Even though I want to push ahead, at the moment I still don't have a work permit, so we have to be sensible. If I did, I think we'd be absolutely fine, because we'd have enough cash flow that if somebody wasn't paying the rent, okay, you're going to be annoyed, but it would be fine. I think at the moment it would have far too much impact. My final thought is something I personally love hearing, that landlords are greedy. Why do landlords need to put up our rent? Which I guess, to give people the benefit of the doubt, I don't know if people look at things from the perspective that they're not in. So if you are a renter, and you always have been, you're probably only seeing something, and you've only been around people that rent from one perspective. Here's my perspective on it. Firstly, everything goes up. So we're talking about inflation. Fuel has gone up astronomically. Utilities, it goes up for everybody at the same rate. The big thing, I mean, we've held our rents for 2 years. Well, actually, on one of them forever. The other one for 2 years, and the other one I think is only a year and a bit into the rental. But there's a couple of things that you have to factor in. Repair costs go up at the same rate as inflation. All of the people that come out and repair our homes, their rates have gone up. It's way hard to get hold of people. Insurance has gone up. My fuel has gone up. My phone bill has gone up. But more importantly, in the UK, it's very common to have a 2 or 3 or sometimes 5-year fixed deal. And you might lock in an interest rate at, let's use a real example, 1.79% on one of the homes. And if we are lucky, because we're now expats, the best rate that we can get now is 4%. So it's gone up over double. Now, you could say I should absorb the cost of that. You could say that. I disagree. I think that the cost has to be passed on to the person renting, because the value of everything has gone up. And another perspective along the same lines that I have is, you have to be in line with the market. So I know full well, especially the house, that will rent for maybe 400 more than we're charging the person at the moment. We've decided not to put the rent up for them, but the actual market rate is £400 per month more. So we're losing out around £5,000 per year by continuing that. The tenants are great tenants, so that's fine. But at some point, all of our income will be eaten into by interest, increased repairs, increased insurance, increased travel, the time that you spend on it. It's not a charity. And I know in the UK it's a little bit different, because you do have housing associations and council that rent at rates that just are not sustainable, as the system's proving, and it's having to change. But for a private landlord who really doesn't make a lot of money, as a percentage out of the homes, I think is probably around 4%, 4.2% before taxes in the UK. So it's really not a huge amount. It might seem like you're paying a lot in rent, but most of that goes out in fees and taxes. The way you really make money is you do have some cash flow, but it's the equity, so somebody's paying it off over time. So I do understand when people think that landlords are greedy and they shouldn't put the rent up, but you're probably not fully understanding the costs and impact that it has on a landlord. And we are not rich by any means, and if we didn't put rates up, whether it's 2 years, 5 years, we had this conversation with one of the tenants, we would have to sell that home, because one of our tenants asked us to keep it the same after the second year going into the third, but because of the rate change, it was impossible. So I said, look, I put up the absolute minimum that I can, and I mean literally the minimum is £100 when it could be 400 more. But if not, we would have had to have sold that house on renewal, and we would have taken the money and put it into a home out here. It just would not have been a viable option for us. So there is a balance between the rate that we have to increase it and what the tenant would like, which is probably a reduction, but a 0% increase. Seems like a little bit of a tangent, but actually that's all part of inflation. Over time, everything inflates. I don't fully understand the system. I don't think you need to. You just need to understand that it exists. There's no point avoiding it. There's no point pretending it doesn't exist. There's no point thinking it doesn't affect you. It does. If you earn 30,000 a year and everything's gone up 20%, you now need 36,000. Anyway, that's my semi-rant over. Hopefully you've enjoyed. Thanks for watching.